Right. I think we can start now. Now it's 8:40. Yes. No, two at least. Two. Has. Why you are not participating today's one? Right. So we are on the stock valuation. So as I remember, we discussed, we did equity share valuation. Under the equity share valuation, we have to discuss different models, with the different assumptions. We have to discuss different models like single holding period, multiple holding period, zero growth dividend, zero growth, constant dividend growth, and then differential growth rate. So as I remember, we discussed all these examples. So if I correct, we have to start from price multiples. Huh? We didn't it. How about this one? This is a declining growth. I think I explained it. No. We did only this. This one. All right. So quickly until others are joining. So let's look at these examples very quickly. Actually, you should do at your home. So then we didn't do this. Right. So let's do this one as a differential growth rate. Look at the question. ABC PLC is expanding rapidly and currently needs to retain all of its earnings for reinvestment purpose. However, investors expect that ABC will begin paying dividends with the first dividend 2 rupees, receiving 3 years from today. Then the dividend should grow rapidly at a rate of 50% per year during year 4 and year 5. After year 5, the company should grow at a constant rate of 8%. So dividend after year 5 should grow at a constant rate of 8% for a future. If investors require rate of return, for the equity shareholders require rate of return, if 13%, what is the value? What is the present value? What is the intrinsic value? What is the fundamental value? So we discussed this differential growth models. I think you may remember. So this is simply example. So you can do it in 5 minutes. What is the value? So you can remember this is with the differential growth. There is a super growth rate as well as constant growth. So I think you have ability to do this one. So if you draw the timeline for this section, for the first dividend, because now this is a rapidly growth company, so they are retaining all their profit for the reinvestment. So the investors expect the first dividend receiving 3 years from now. So first dividend will receive in 3 years from now. So you will get 2 rupees in 3 years. You expect with the analysis of the company's data, you may expect 2 rupees in 3 years from now. After that, the dividend should grow at a rapid rate of 50% for year 4 and 5. For this period, during year 4 and 5, dividends are growing at rapid rate at 50%. After that, company's dividends are grow at a constant rate of 8%. So after the year 5, there is a constant growth in dividend for a long period, for an indefinite period at 8%. So you have to calculate dividends relevant for the period. Now this is a differential growth model. To the point where the constant growth is started, you have to value the share. Then you have to discount all expected dividends and the expected value to the point where the constant growth is started to the present. So that is the value. So you can calculate dividends from year 3 to 4. Dividends are growing at 50%. So D4 should 2 rupees should increase by 50%. So 2 into 1.5. So how much the D4? D4 is how much? 50, no? 3 rupees, no? That is 3 rupees. Then year 4 to 5, again, dividend is increasing by 50%. So 3 into 1.5. So again, 4.5, no? 4.5. So these are the 4.5. These are the expected dividend for year 4 and year 5. So according to the section, you can see after year 5, there is a constant growth in dividend for an indefinite period. To which point then you have to value the share? End of year 5 or end of year 6? End of year 5. Because from the year 5, there is a constant growth in dividend. So you have to value the share to the end of year 5. So then you can know you have to apply constant dividend growth model. So value at year 5 is equal D6 divided by required rate of return minus constant growth rate. So D6 you can calculate now. D6 is equal 4.50 should increase by 8% divided by investors required rate of return 13%. Constant growth rate of dividend is 8%. So you can calculate the value. So value at year 5. What? Huh? Huh? This one? You told me that we didn't. So no need to discuss, no? අනේ ළමයිට මතකද නැහැ. මට මතක නැති නේද? සාධාරණයි. මම හිතන්නේ අපිට මෙතනින් පටන් ගන්න තියෙන්නේ price multiples. What is the answer here? සමහර අය ඉන්නවනේ මේක first for the doing for the first time. What is the answer? Final answer. For here value. Value is how much? 97. 97.4 is the value here. 2. 97.2 is the value here. So you have to discount each expected dividends and the expected dividends and value here to the present. So then you will get the answer, final answer. 50. 57.85. So you can do it later, right? if you have not did it fast. Right. So we are moving to the price multiples. Right. So far we discussed equity share valuation based on the expected dividend, expected price. Right. So when you apply the dividend discounting models, you should know what is the expected dividend, what is the expected price. So as I explained at the beginning, equity share valuation is difficult, not like the bond valuation, not like the preference share valuation. Because in case of the bonds, in case of the preference shares, you know what is the expected coupon. You can forecast with a certain certainty expected coupon as well as expected dividend. But in case of here, in the ordinary shares, the dividend is changing. Dividend is not a fixed one. So therefore, we apply different methods, different models to calculate the intrinsic value of the share. So we discuss up to this dividend-based models. So now we are going to the next one, that is different price multiples. Price multiples. This is highly applicable in the real world. Financial analysts, investor analysts, or managers, they are mostly using these price multiples when they are doing the stock market investment to identify undervalued and overvalued stocks. This is practically highly applicable price-based multiples. So let's see, this is very simple. Price multiples means we can identify different variables related to the price. You can calculate different multiples. So based on this particular multiples average or the industry average or the competitors average, so by taking this variable in our company, you can forecast the price. So that is the way. So we can use price to earnings multiple, price to book value, price to sales, price to EBIT, price to book value. So like that, certain multiples we can discuss. If you go to the chapter, the recommended textbooks or the reading chapters, you can see there are so many price-based multiples. This is a relative valuation approach where the value of the stock is compared the values assessed by market for similar comparable companies. So here, actually no need to know what is the expected dividends, what is the expected cash flow, what is the expected price. So no need to forecast. Simply, you can calculate past average price to earnings multiples. So then based on this average of a particular company, you can forecast the price. So let's look at with the example. So I have mentioned here only the three price-based multiples: price to earnings, price to book value, price to sales. So normally, if say price to multiples, say if it is 25, what is the interpretation? What is the meaning of that? This is price to earning multiples. So normally we mention it as a 25 times, like times. So what is the meaning? If it is 25, price to earning multiples, if it is 25, it means that for 1 rupee of earning of this company, investors prefer to pay 25. So that is the meaning, price to earnings. So this is based on the variable here, earnings, profit, right? So if you take the price to book value, if price to book value multiple say price to book value, if it is say 10, what is the meaning? For 1 rupee of book value of equity, investors wish to pay, or investors would pay 10 rupees. So when the price to earning multiples is increasing, right? If it is increasing, it is a good indicator. It is a positive indicator. It means that this particular company is very attractive. This company is for this company, investors are willing to pay high. If it is say increasing to 30, price to earning multiples is say 30 times. So what is the meaning? 1 rupee of earning, for the 1 rupee of earning, investors would pay 30. Right? So when it is increasing, it shows the attractiveness of this particular company. So likewise, you can calculate past 10 years price to earning multiples of the company, or you can calculate past 10 years price to earning multiples of this particular industry, or your competitor, rival company. So based on this as a benchmark, you can calculate company value. Suppose that say this is the industry average. Suppose this is the hotel industry. This is the price to earning multiples for the hotel industry by considering past 20 years data. So you are say you want to value say company 8 expense hotels. You want to value that. So then you know this is 2023. You know what is the earnings of this company for the 2023. Say this is 1 million. So likewise 1 million. So then you can calculate earning per share of this company for 2023. So this earning per share you multiply by this average price to multiples. So that is the value, that is the price of the company. So that is very easy. No need to expect a dividend, no need to forecast prices. Simply based on the past data, publicly available data, you calculate different multiples like price to earning, price to book value, price to sales, price to net asset, price to EBIT. So likewise, there are 20-30 price multiples using a particular variable. Then based on that, you can value the company as you require. This is very easy one. But remember, practically, this is highly useful to calculate the value of the company. So let's look at this example. Price multiples, price to earning multiple. This is the ratio of market price per share to earning per share. So price to earning multiple, you can calculate the price to earning multiple. You can this is the market price per share to this is the ratio of market price per share to earning per share. So market price per share divided by earning per share. So you can take past 10 years or past 12 months or whatever the period. This is a kind of a ratio. Market price to earning ratio. Price to earning ratio. Investors use this multiple to compare the company's market capitalization to its earnings. So this benchmark or the benchmarker can be a company average or sector average or industry average, or you can take rival company to take this as this benchmark. Now let's look at this example. I think you can identify that one with the example. Galle PLC's common share is currently traded for 80 rupees. Right? The company shares currently trading for rupees 80. Historical average, past historical average price to earning ratio is 10. Past historical company average price to earning ratio is 10. And outstanding number of common shares is 3 million. Number of shares 3 million. Number of shares is 3 million. The reported earnings of the company for the most recent financial year is 22.5 million. Company earning for the very recent or the current or the very recent financial year, 22.5 million. 22.5 million. This is 3 million. Number of shares is 3 million. So estimate the value of this common share, value of this company's common share using price to earning ratio. So this is the past average price to earning ratio. This is the benchmark, right? This is the benchmark. So this is the company's current situation or the most recent situation of the company. Their number of shares is 3 million. Company very recent previous year earnings is 22.5 million. So then you can calculate company earnings per share. Company earnings per share for the very recent year based on the annual report data. So earnings per share is equal 22.5 million earnings divided by 3 million shares. So company recent earnings per share is equal 7.5. Earning per share is 7.5. So now you know price to earning ratio. Price to earning multiple is 10 times. Company current recent earning per share is 7.5. So how much the intrinsic value? How much the value? So simply value is equal past average price earning multiples multiplied by company earnings. Because the variable here earnings. So earning per share is equal 7.5. So you will get value is equal 70. This is the intrinsic value. This is the intrinsic value or the fundamental value. So remember, when I start this security valuation or the stock valuation topic, I defined you intrinsic value is equal present value of the expected cash. So that is one definition. So an intrinsic value you can define based on these different price multiples also. Practically, for the decision making, most applicable one is the price based multiples. Practically, very important one is the price based multiples. Now suppose that I think answer is there. Now current price of the company is 80 rupees. Value 75. So then what is happening for the company shares? Overpricing or underpricing? Currently trading price is 80. The value, fundamental value should be for the company shares is 75. So then it means overpriced. So likewise you can compare to take the decision. So now are you buying? When there's overpricing, you may not buy, you may not invest. So when the underprice, if the company shares is underpriced, you may buy. Okay, right? So this is very easy, not like the previous one. So if you take another example, look at this one. Price to book value. Price to book value. Price to book value. Market price per share divided by book value per share. So variable here, book value per share or the company book value. You know what is book value? Book value is the balance sheet based number. Book value of equity you can calculate total asset, total balance sheet asset value minus total liabilities. So that the remains of the balance sheet is equal equity value. Based on the balance sheet historical data, you can identify the book value, total asset minus total liabilities. So the remains is the equity value. So based on the here, price to book value ratio, you can calculate again value. The variable here, book value per share. This is ratio of the market price per share to book value of equity per share. So book value of equity you can calculate total asset minus total liability. So then you will get the equity. So equity divided by number of shares. Right? For the balance sheet you can take total asset book value minus total liabilities. Liabilities, so the balance is equity. So this is divided by number of shares of the company. So that is the book value per share. So then investors use this multiple to compare company's market capitalization to its book value of equity. So this is the book value of equity. This measures the price investors are willing to pay for 1 rupee of book value of the company, 1 rupee of the book value of equity. Right? So earlier for the 1 rupee of earning, here 1 rupee of book value of equity. If you are taking price to sales multiple, if price to sales multiple is 10, it means that for 1 rupee of sales, investors are willing to pay 10 rupees. So variable is sales. Are you clear this? Price multiples? I have mentioned only the 2 price multiples, but there are more than this. Using different variables like earnings, book value per share, sales, EBIT, net asset. So likewise, different price-based multiples you can calculate. Hemas PLC fast average book value per share, book value price to book value ratio is 9. Right? Price to book value per share ratio is 9 times for the Hemas company. Book value of equity as per the most recent financial statement of the company is 18 million. Book value of the company for the as per the recent financial statement is 18 million. The outstanding number of common shares of the company is 1.5 million. Number of shares 1.5 million. Current market price is 100 rupees. Currently, this Hemas PSC shares is trading for 100 rupees. So calculate the value and let me what is happening with the Hemas PSC share, whether it is overpriced or underpriced. So this is based on book value per book value of equity. So based on the book price to book value ratio, what is the value? So you can calculate book value per share is equal 18 million divided by 1.5, 12. So book value per share, current book value per share of the company is 12 rupees. So then how much the value? The value of the company is equal price to book value. This is the past average. This is the benchmark. 9. You can in the past, investors have been paid 9 rupees per 1 rupee of book value. This is the average. So based on that, you are valuing the company's current value. So that is 9 into 12. So you will get 110. 8. The value is 108. So what is happening? Currently trading for 100 per share, 100 rupees per share. So now the value is 108. Again, underpriced or overpriced? Underpriced. So there is a good time for the investment because currently the stocks are trading at underpricing. So if you wish, if you are going to invest for the Hemas PSC, so this is a good time. You can invest because underpricing is in the market. You can see there is the underpricing. When the market is correcting, you can have a capital gain. If you invest at 100 within very short period, market will be correct. Market will reach to this correct price. So when the market is correcting, you can have capital gain, 8 rupees of capital gain. If you invested today for 100 rupees, when the market is correcting, you will get 8 rupees as a capital gain. Right. So this is the price multiples. I will explain only these two. You can read further to identify other different price multiples. Based on the different variables, you can calculate price multiples. So price is the all the variables we calculate to the price. Price is the denominator. Right? So based on the price, we calculate different multiples. Right. Now, what is the conclusion? Which approach is the best? No single ratio can tell investors all they need to know about the stock. By using only the dividend discounting model or either this price-based multiples, you may not capture holistically what is happening in the company. So therefore, it is better if you can use dividend-based models as well as this price-based models. If you can use both before taking the decision, that is appropriate. But anyway, it is important to use variety of ratios to arrive at a complete picture of the company, about company's financial health, rather depending on one particular model. Price earning multiples or the price-based multiples remains popular in the practical scenario to take the decision. Mostly we are using price to earning multiple. Price to earning multiple to take the decision. However, theoretically, very strong one is the dividend-based model, dividend discounting model. So this is the conclusion. So we discussed price-based multiples and dividend-based model. So now we are going to last point, preference or the preferred stock valuation. So we did bond valuation, ordinary shares valuation, and the last preferred stock valuation. This is very easy because you know what is the value now. When it's come to the preferred shares, you know what is the difference, what are the differences between ordinary shares and the preferred shares? Can you explain? Yes. What are the differences? What are the characteristics make difference between ordinary shares and the preferred shares? What is the difference then? You are getting a fixed dividend. For what? So, ordinary shares represent the ownership for the owners of the company. So, preference shares are of the capital actually. So, when it comes to the preference shares, as you mentioned, I think you are getting fixed dividend. Dividend is fixed. At the issuance, you will know how much your dividend rate. But in the preference shares, but in the ordinary shares, not like this. You get dividends depends on the director board decision, depends on the company performance, earnings, economical situation, investment opportunities. So likewise, certain variables are affected for the dividends decision of the ordinary shares. Right. So when it's come to the preference shares, again the valuation part is easy because you know what is your expected dividend, what are your expected cash. When we come to the preferred stock, two categories are there: redeemable, unredeemable. Preference shares with the maturity, we call redeemable one. Unredeemable means there are certain type of preference shares, no maturity. As far as the company is surviving, as far as the company is doing that business, these stocks or securities are there. So like a equity share, the difference between the equity and this, they are getting fixed dividend. They are getting fixed dividend. No maturity for the equity or the ordinary shares also no maturity. Right? For the ordinary shares, no maturity. For the unredeemable preference shares also no maturity. The difference is ordinary shares or the equity not getting a fixed dividend, but here for the unredeemable preference shares, they will get fixed dividend. So that is the difference. So you should know how to value redeemable one as well as unredeemable one. If it is redeemable, you know that in case of the redeemable preference shares, say this is a 5 years the preference shares or the preferred stock with the 5 years to maturity. Suppose par value is 100. Normally, in the preferred stocks, for the preferred stock, face value, par value, we consider as 100. Say this dividend rate is 10%. This is fixed, right? Not changing. If it is 5 years to maturity, if this shares, preference shares is 5 years to maturity period, if it is 5 years, so during these 5 years, if you say invest today on these shares, annually you are getting dividend for 5 years. At the maturity, you will get face value, like bonds, like bonds. Now in this example, how much the dividend here? Normally, like bonds, dividend amount we calculate based on the face value, 100 into 10%. So you will get 10 rupees as the dividend for 5 years. At the maturity, in addition to this dividend, you are getting 100 rupees as the face value. So these are the expected dividend and expected cash flows for preference shares. If you invest today at 90, if you invest today on this preferred stock at 90 rupees, are you getting capital gain or capital loss? Huh? If you invest today at 90 rupees, you will get capital gain. Because 90, today's trading price, say 90, at the maturity you are getting 100. So there is a capital gain. If you invest today at 120, so you will end up with the capital loss. But you are purchasing at a premium because of the high dividend rate. Like bonds, nature is similar to the bonds. Right. So then you know how to calculate value. Nothing to teach here because we have did one valuation. You know what is intrinsic value. You know how to calculate that one. So then you have to discount all these expected cash flows to here. So that is the intrinsic value for the preference share. Only difference here, the discount factor we are using is preference shareholders required rate of return. So preference required rate of return of the bond holders is different from the required rate of return of the preference shareholders. You know the reason. What is the reason? Because of the risk. When comparing to the bonds, which is risky? Bonds or preference shares? Which one is risky? Huh? Which is risky? Bonds. Not bonds, not the bonds, preference shares. At the bankruptcy, if the company is bankrupt, first priority is going to the debt capital. Well, basically bonds, bank loans, debentures, then for the preference shares, ultimately, finally, for the ordinary shares. So this is risky compared to the preference shares. Again, this is risky. This is risky because they have a first priority, so they are taking the second priority. So the risky one is preference shares. Right. If it is unredeemable, in case of the unredeemable preference, okay, we'll do the example for this one quickly. ACL has issued preference stock 100 rupees par with 12 years to maturity. 12 years to mature. It pays 10% dividend annually. So you know what is annually. So dividends you are getting per annum. If investors require a return of 11% per annum, what is the value? What is the intrinsic value for this preference shares? So you know how to calculate intrinsic value based on the expected dividend and based on the expected dividend and the expected cash flow. So this is formula. I will show you the formula here. So dividend here is an annuity. Annually, semi-annually or quarterly, you are getting same dividend. So then this is an annuity. So dividend you have to discount it to the present considering as a annuity type cash flow. Then redemption price or the maturity payment, RP is the redemption price, is a single lump sum payment. You have to discount considering as a single cash flow. Here R is preference shareholders requirement of return. After the risk capital, our next topic is cost of capital. When you calculate the cost of capital of the company, this is our cost of preference shares. So we discount expected dividend and expected redemption price using this preference shareholders required rate of return. Right. Quickly calculate the value. So this is the formula. So now do the calculation. So again, you can draw the timeline for here also. So if you draw a timeline, here face value is 100, annual dividend rate is 10 rupees, 12 years to maturity. So this is for 12 years, right? So like for the 12 years. So annually you are getting 10 rupees as the dividend because 100 is the face value, 100 into dividend rate 10%. So you will get rupees 10 as the dividend. So at the end of year 1, end of year 2, so likewise for 12 years, you are getting 10 rupees as the dividend. At maturity, you will get this face value. So in addition to this 10, in maturity, at 12 year, you will get the face value also. So these are the expected cash flow. So based on the expected cash flow, so you can value this preference share. Value of this preference share is equal. This 10 rupees is an annuity. So you have to take here present value interest factor annuity to calculate the present value of this dividends. So the 100 rupees is a one period payment, so single lump sum payment. So you have to discount it by using present value interest factor. So you know how to calculate present value interest factor annuity. 1 minus 1 plus r into the power minus n divided by r. Here 100 into 1 plus r into the power minus n. Here discount rate or the required rate of return is given. It is 11%. So 1 minus 1.11 time is 12 years divided by 11%, 100 into minus 12. So this is the value. Value is equal . .93.5. Answer is 93.5. This is the intrinsic value. Yes, I think that is correct. 93.51. So you can compare this with the trading price to make the decision. Right. If it is unredeemable, no maturity. Unredeemable preference shares mean no maturity. So this is like a perpetual cash flow. As far as the company is there, you are getting dividend. So you know what is the model. If it is a perpetual type of cash flow, so you can calculate value simply. You can recall the time value of money discussion. If it is a perpetual type annuity, present value is equal annual cash flow or the periodic payment divided by discount factor. If it is unredeemable preference share, simply intrinsic value you can calculate annual dividend divided by preference shareholders required rate of return. So that is the model. Suppose that DPL pays 15% dividend for the perpetual preferred stock. So perpetual means no maturity, no face value, no redemption payment, no maturity. Right? Face value again 100, but no maturity. So then 15% is the dividend rate. Par value of the stock is 100 rupees. Suppose the required rate of return is 10% annually. What is the value? What is the value? So value you can calculate. So this is a perpetual type preference shares. Value is equal 15 divided by 10. 15 rupees divided by preference shareholders required rate of return. So you will get 150. This is end of the security valuation. Yes, this is end of the security valuation. So we discussed security valuation, bond valuation, ordinary shares, and the preference shares. So now our next lesson, risk and return. I think I have given you the tutorial. Few questions from the tutorial I did during the lecture, but right. So you have to look at these questions. This is your tutorial. You may do this thing at home. I think all these questions now you can do because we did similar type of examples in the lecture discussion. So you may look at them and do. It is required, right? You may practice, and I think we discussed this question. This one we did. This one also we did. Right. So others you have to do. Right. So now we are going to. I am going to start risk and return. Our next lesson is risk and return. Why? Shall we move to the next one? So when it comes to the risk and return, again very important trade-off, important topic. Might be technical. But anyway, I think you can do because in your statistics, I think you have standard deviation, variance, coefficient of variation, sign calculations. So we are applying the same statistical properties tools here to calculate the risk and to identify the return. So therefore, that knowledge you can apply again here, right? So let's see risk and return. So what is the relationship between risk and return? As a general, with your general knowledge, you can say what is the relationship? What is the relationship between risk and return? Huh? Yes? I always ask this question from you because you are my friend. What is the relationship between risk and return? Positive. Positive means higher the risk, higher the expected return. Suppose if you have 1 million with you for the investment, if you are investing this money in the industry like government bank, your return rate of return is low or it is lower than if you are going to invest this 1 million in the stock market. Okay? Because the investment in the stock market is risky compared to this industry bank fixed deposit. So if you are going to invest this 1 million in stock market, listed companies, so your required rate of return should be greater than the interest rate you are receiving from the industry fixed deposit because of the high risk. Higher the risk, higher the expected return. If you are investing in the stock market, your expected return is greater than the expected return of the government industry like bank industry. Yes, you are perfectly correct. There is a positive relationship between risk and return. So what is the connection this risk and return to the our objective? What is the objective of financial management? Maximizing shareholders' wealth, maximizing value of the company, maximizing market price of the share of the company. So likewise, you know what is our objective. Right. So when we say the value, as we did time value, different application with the security valuation. So value depends on expected cash flow. You discounted using some discount factor relevant for that time. So this is very basic fundamental model of the value calculation. Value depends on the cash flow and also your required rate of return. So this is the discount factor. If you are calculating the company value, this is our cost of capital of the company. If you are calculating the value for the bonds or the equity shares, like this is investors' required rate of return from the investor's perspective. From the company perspective, that is again cost of capital. Right. So now, in order to maximize value, you should know what is our discount factor. What is our required rate of return? Now, when it's come to the required rate of return is equal risk-free rate of return plus risk-free mean. Right? Required rate of return is equal risk-free rate of return. So risk-free rate of return for your time value plus risk-free mean. So here risk-free rate of return again include two components: real rate of return and expected inflation. Real rate of return and expected inflation. So here, this is the formula for calculating required rate of return. This risk and return lesson, I am starting with this formula with the capital asset pricing model. That lesson I will stop again with this formula because this is kind of a story with the diversification effect. You will realize this thing. So I am starting with this formula equation as well as, and I ending this lesson, not probably today. Again, I will stop this part. So your required rate of return is equal risk-free rate of return plus risk premium. Risk-free rate of return you can extract by looking at the government treasury bills, government treasury bonds. These are the proxies for risk-free rate of return. So then risk premium. Risk premium. How to calculate the risk premium? If you are going to invest in the equity shares or listed companies, so how to calculate this risk premium? So you should be able to quantitatively identify this premium. So with the capital asset pricing model based on the market portfolio, with this risk and return lesson, we are going to calculate this risk premium. Right. So I am talking about the connection of this lesson to our objective. So here this required rate of return you should know in order to calculate value here. Right. In the next lesson, that is cost of capital. So when I discuss this again, this is our cost of capital. This is our required rate of return. This is the discount factor. Same variable we defined with the different in the different context, in the different aspect. Right. So this is connected to our objective. So without knowing our required rate of return, you cannot maximize value. You cannot calculate value. I will try to do this as uh, as as much as I can in the simple manner. This is a bit technical. When I go to the market portfolio, I think you will confuse definitely. But anyway, I will explain in very simple, with a simple manner. I will try my best. Right. So now let's go to the expected learning objectives or the learning outcomes. At the end of this lesson, you will learn what is return, what is risk, how to determine return, how to determine risk, return for the individual investment, individual asset, return for the portfolio. Why investors are going to construct the portfolio rather than investing in particular one investment. You will learn what is the diversification effect. We are constructing the portfolio to maximize return at a minimum, at minimized risk. So we construct the portfolio to maximize return and minimize risk. So diversification effect. And finally, we go to the market portfolio with the capital asset pricing model. We are going to calculate this risk premium. So these are the things that we are going to discuss under the risk and return. So ultimately, when you reach to the end of this one, you will learn what is diversification, what is the diversification impact, why we construct a portfolio than investing in the individual assets, and finally with the CAPM using the market portfolio, using correlation covariance structures, you will realize how to calculate this risk premium. One thing I want to mention, this topic I discussed related to the equity shares. Right? The asset I am taking here, equity, ordinary shares, not the bonds, not the preference shares. We discussed this topic related to the equity or the ordinary shares. Right. So not much things to complicated. So let's start with the return. What is return? All right. Before going to that, we can read this introduction. Silent, please read this. This is included what I explained. No? right? So you can actually I explain the story. So risk and return are two fundamental concepts in finance. Higher return generally considered good. Normally, as a human being, we like to have higher return. That is nature. But now, as finance student, you should know higher return means it implies that higher risk. So you may invest in the pyramid like unethical businesses, pyramid, what we call subpiti. Subpiti. At that time there was a subpiti kind of thing. Matakane subpiti la invest karala total wealth එක destroy කරගත්තා. So we went there for the higher interest rate to get the higher interest rate. So ultimately what happens? That people was not knowing that higher return, high interest rate means high risky, high risky. Because this risk and return is going with tender. Higher the risk, higher the expected return, higher the risk. So as a investor, normal, rational, logical investor, you always a risk averse person. We are not taking unnecessarily. We are not taking unnecessarily risk. You must take risk to a certain level, but not unnecessary. Because high risk means you are getting high return, but anyway high risk. Now, suppose that if you are going to invest in the stock market, risky. If you invest in the Hemas PLC, you are expecting the dividends. If economy or the country or the company performance, it went for a positive or the good side, you will get that expected return. But if they went worse, you will lost. You will end up without any dividends. So that is the risk. But anyway, there is a possibility to get high return. So good, having high return is good, but you should know risk and return going with tender. Higher the underlying risk of an investment, its expected return would be high, right? So when you look at higher interest rate for a particular investment or particular company, particular finance company, so you should realize it now. It means that high risk. High risk. So risk is the uncertainty. Uncertainty or the possibility of not having the expected thing. So that is the risk. So that is high risk. Thus, investors of finance assets are willing to have a trade-off between risk and return. So you have to manage this trade-off. So that is why we construct portfolio. You are taking risk to a certain level to maximize the return. So investors should be able to make this decision by having this trade-off between risk and return. Investors invest in portfolio of different stocks. If you invest, suppose that if you put all the eggs in one basket, if that basket fallen out, all the eggs will destroy. So likewise, if you invest your total wealth in one particular company, one particular investment, if that company destroys or if that went bankrupt, so your total wealth will destroy. So that in order to avoid that, you may invest in the different assets. You invest part of your wealth in the treasury bills, part of your wealth in the fixed deposit, part of your wealth in the stock market, and also in the real assets like gold and other countries, certain type of investors. So likewise, you are constructing a portfolio. Portfolio is a collection or the we call in single ආයෝජන කලබක්. අපි හැමලේම ආයෝජන කලබක් මල්ලක් තියාගන්න because of the risk. Because to diversify the risk and maximize the return. So investors are investing in the portfolio rather than investing in the one individual asset. So as an investor, you should know how to calculate return and risk for portfolio as well as for the individual assets. So calculated the value of the security here as the present value of cash flow stream provided to the investor discounted at the required rate of return. So that is the appropriate discount factor for this particular risk level. So this required rate of return is compensation for the risk. So this should be the discount rate appropriate for this risk level. Higher the risk, this discount factor should high. Lower the risk, this is go below. So likewise, this is in line with the particular risk level. So recognize that risk must be considered in determining value and making investment decisions. So this is the overall introduction of the lesson. So this is a big picture of the risk and return. We will discuss only the very fundamental things related to this risk and return. If you are interested, you have to go to the portfolio management. So likewise, certain advanced areas are there. But anyway, here we discuss only the basic, fundamental things. Right. What is return? What is return? Is it profit? Return. Is it profit? What is the difference between the profit and the return? Profit and return. What is the difference between the profit and the return? Huh? What is the difference between the return and the profit? Profit. Yes, carry on. Huh? Net cash is the profit. Not really.
And for investment, nothing for operating.
So companies doing the investment, so operating. Speaking too much. I'm asking very simple question. So it is based on. Yeah, profit, you know, it's as you mentioned, it's a accounting number, accounting concept. So you calculate on the actual basis, you certain concept like. So profit simply income minus expenditure. You know that in accounting, when you identify the income, either you receive it in cash or not, to the point where this particular transaction is included and the return. But actually, it is a maybe credit sales, but we consider it as a sales. So likewise, when you calculate the profit, you remember it includes some non-cash items, accrual things, provisions. So likewise, profit is a kind of thing. So return means cash flow. Return is the cash flow. So that is not the profit. Return is purely cash flow. So return received. So I again mentioned that we discuss this topic based on the equity shares, based on the ordinary shares. Investment or the asset we are using here, equity or the ordinary or the equity shares. So return is the cash flow. So if you invested in a equity shares of the company, what are you expect the return? If you invested in a ordinary shares of a company, what are the expected return? You will expect dividends and capital gains. These are the expected returns. So this is cash flow, not the profit. Cash flows received on an investment plus any change in the market price. So that is dividend and the change in the market price. So when the market price is changing, you will get the capital gain or loss. So usually expressed as a percentage of the beginning market price of the investment. So return we can say in terms of the rupee or as a fraction or as a in decimal format or as the percentage rate of return. Normally, return we exhibit or we present as a percentage, as a rate of return. Right? Normally, not as a rupee return, not as a fraction, not as a decimal point of return. So, normal exhibition or the normal presentation of the return is, it is as a rate of return. So, return you can calculate, we consider the equity market or the stock ordinary share investment. So, return is equal dividend yield plus capital gain yield. So this formula implies dividend yield plus capital gain yield. Return is equal dividend yield. So dividend means dividend per share at the time t divided by initial price P0 or here it is put as a PT minus 1. For the simplicity, I am taking P0 and P1. PV, P1, T minus 1 means P0, previous price and the current price. So you can see the definition PT, stock price at the time period T, current. PT minus 1 is price at the T minus 1, previous price. So this is dividend per share divided by price P0. Then capital gain. Capital gain, say P1 minus P0 divided by P0. So this is we call dividend yield. This is we call capital gain yield. So this is normally we exhibit as a rate of return. So therefore the answer should be multiplied by 100 to present it as a percentage rate of return. So here T minus 1 is the P0, PD is the P1. Either this one or this one you can use, but my normally P0, P1 is easy, but I have taken from a book I think. So here you can see the two expected things in the return if you are investing in the stock market is dividend yield and capital gain yield. So here you can see the variables. R is the return. It can be actual or expected, right? Or based on the past data, you can calculate return. Based on the forecasted data with the probabilities, you can calculate the return. Both we discuss. T refers to the particular time period, past or future. DT is the cash dividend at the end of the time period T. PT is the stock price at the time period T. PT minus 1 is the stock price at the time period T minus 1. So likewise you can calculate return using this formula. You can apply this formula for the past data as well as for the expected data. So this is actually the what I made here. For this return, we call as holding period return. Holding period return. Because if you invested in a company share in a listed company, for the equity share, no maturity. For the equity, for the ordinary shares, no maturity. So therefore, but you are investing for certain period, maybe for 6 months, 90 days, 150 days, 1 year. So likewise for a certain period. So you can apply this formula to calculate your holding period return for your investment. So this simply you can read them as holding period return for the holding days of your investment. So let's go to the example. I think not much difficult. So let's look at this one. Sama purchased 250 common shares of Lion PLC at 180 rupees per each. Company paid dividend of 3 rupees per share during the holding period. During the investment, company has paid 3 rupees as the dividend. Sama sold all the shares at a total value of 50,000 after 190 days. So Sama's holding period is 190 days. 190 days. Calculate Sama's holding period return. Or calculate Sama's return. So the Sama's return is her holding period return for the 190 days. For the holding days. So how much the Sama's return? So you apply this formula and you can calculate it. So you can apply the formula holding period return is equal dividend per share divided by P0 plus capital gain yield. So P1 minus P0 divided by P0. So you have to split this as a percentage rate of return. So multiply by 100. So here P0 is 150. Sorry, 180. How much the P1? P1 is how much? At the end of the holding days, Sama sold all the shares for 50,000 rupees. She bought 250 common shares of this company. So then P1 is equal 50,000 divided by 250. Next, 50,000 is equal, 50,000 divided by 250 is equal P1. Selling price. It is 200, no? It is 200. 200. So during the holding days of 190, Nama receiving 3 rupees of the company dividend. Then her holding period return is equal, capital gain yield is equal 3 rupees divided by P0, 180. This is capital gain yield plus dividend gain or dividend, capital, this is dividend yield, 3 divided by 180 is the dividend yield, plus capital gain yield. There is a capital gain, because initially you invested at 180, at the end of the holding days you are selling these shares 200 each. So there is the capital gain. 200 P1 minus 180 divided by 180 into 100. So how much the holding period return? 12.20. 12.7. Holding period return is equal 12.7. Now look at this. Holding period return is 12.7. Alternatively, suppose that you or the Sama can invest your money in a fixed deposit at an annual rate of return 19%. Rather, investing of this particular company, she can invest alternatively in a fixed deposit at 19% per annum for interest. Interest of 19% per annum. What is the decision? Suppose you are as the Sama. Are you investing in the Lion PLC or fixed deposit? Huh? What is the choice? If you go to the fixed deposit, 19%. But this Lion PLC, your holding period return was 12.7. So your choice, decision, fixed deposit. Any other alternative answer? You all are going for with the fixed deposit. You also fixed deposit. No. Why? Huh? Why? Is there a capital? No. If you are not going with that one, you may like this 12.7 is lower than this one. So again you are going with the fixed deposit. If it is for the fixed deposit, 19%. If you consider the risk and return theory, there is a contradiction, no? There is a contradiction. You feel like this. There is no any contradiction. You are going with the fixed deposit. All are wrong. Why? What is the reason? What is the reason? Yes, holding days. Holding days. Normally, remember, banks, central bank, financial institutions, they always present rate of return per annum. Now, if you go to the bank and you ask from the manager what is the interest rate today, he is not telling 1% per month, like he is not telling like this. He simply say 12%. So 12% means per annum. Normally, in a section, in banks, institution, reporting, always they present the rate of return per annum, not per month, not per quarter, not per daily. So normally return exhibit as an annual rate of return. Now here, the fixed deposit of this alternative is per annum 19%. But here, life PSC investment for 190 days. These are in two different formats. This is per annum for 365 days. This is for 190 days. So you cannot compare. You cannot compare. Now to comparability, in order to compare this holding period return with other alternative investment, fixed deposit, treasury bill investment, bond investment, whatever alternative, you have to convert this holding period return as an annualized rate of return. You have to annualize this. This is holding period return. Now you have to annualize this to compare with this alternative. So how to annualize? Simply what you have to do, you can annualize your return, holding period return divided by holding days multiplied by 365. Normally you may take 365 as the days for the year. So you can annualize holding period return divided by holding days multiplied by 365. So now how much the annualized rate of return? Here 12.7. Your holding period return was 12.7 divided by 190 multiplied by 365. So annualized rate of return, this is actually the formula for the holding period return. This is holding period return formula. So holding period return divided by holding days multiplied by number of days per year. So you can get the annualized rate of return is equal what is the annualized rate of return? 24%? 24%. Now what is the decision? Now you can see higher the risk, higher implied return. If you go to the Lion PSC, you will get 24%. If you go to this fixed deposit, you can see it is 19%. It was yes, it is 19%. So now you can see that comparison based on your risk appetite. If you are a risk taker, if you wish to take certain level of risk, you can go to the Lion PSC, or if you are a risk averse investor, you can go with the fixed deposit at a 19%. Right. Two concepts I explained: holding period return and annualized rate of return. Shall we have a break? 15 minutes before going to the risk and this. You mentioned me. We have a break. I have my tea also. 15 minutes. What is the I'm searching Good morning. Oh, down nine, right? Okay. Okay. මම මේවට කෝල් එක ගන්න ඔයාලා ඉල්ලන්නේ කවද්ද? lecture සිවුරේ කවද්ද කියන්නේ? කවුද කියන්නේ? Report submission. दासे सबमिशन डाला नामे सबमिशन दासे प्रेजेंटेशन वेरे गवर्नमेंट को पालन करेंगे oh ඒක 1 week before වම ගන්නවා ඊට පස්සේ next after the submission තමයි ඊළඟ week එකේ presentation එක එමුණක් අපිට ලාසේ දාලා 23 presentation ඔයාලගේ academic calendar එකක් තියෙනවද අපිට කවදාද යනවද කියලා මම හරියට මතක පරිචය කරනවා එනම් change කරන්න ප්‍රශ්න ඔව් මම ඔයාලට mail එකක් කරනවා නේද අර දැන් ඔයාලගේ ඉංග්‍රීසි නම්බර්ස් කරලා තියෙන groups වල මම හදපු groups එක ඔයාලා දැම්ම පොඩ්ඩක් ඒ ඉංග්‍රීසි නම්බර්ස් ටික අප්ඩේට් කරලා දෙන්න දැන් මෙහෙම දැම්මනේ ඔව් මම ඔයා දැම්මනේ අපි චේන්ජ් එකක් තියෙනවා ඒ මේල් එකට මම රිප්ලයි එකක් දැම්මා දැන් මම groups හදුවනේ ඔයාලගේ ඒ groups වල අර ඉන්ඩෙක්ස් නම්බර්ස් වෙනස් වෙච්ච ටික චුට්ටක් බලලා මට අප්ඩේට් එක දෙන්න. ඒ ටික රිෆ්‍රෙෂ් කරලා මට අප්ඩේට් එක මට රිසෙන්ඩ් දාලා දෙන්න. ඕ නමුත් අර දැන් මම groups හදපු විදිහට නෙමෙයි දාලා තියෙන්නේ. නෑ ඔයාලා තියෙන අප්ඩේට් ඉන්ඩෙක්ස් ටික. දැන් මම අර groups කැඩුවනේ. ඒ groups වල ඉන්ඩෙක්ස් නම්බර්ස් වල ඒක අප්ඩේට් කරනවා. ඒ විලාව. කුයිස්ට් යනවා 120. ඔව් දැන් ඔයාලා හතරටම ඇවිල්ලා තියෙනවා නම් වැඩිම දෙක තමයි ගන්න. ඔව් ඇවරේජ් මිනිමයි දැන් හතරටම ඇවිල්ලා තියෙන එක ඇවරේජ් ගන්න පුළුවන් ප්‍රශ්නයක් නෑ. ඒක මොකද කියපරනම් මේ එන මාක්ස් විදිහට තමයි ගොඩක් පිට ඉෂුව එකක් එන්නේ. දැන් එක්සල් වල තිබුණා දැන් මොකද දෙක පිටවත් දෙකකට දෙකේ ඇවරේජ් weight එක කියන්නේ දෙක. හතරට අප කෙනාගේ weight එක කියන්නේ හතර. ඇවරේජ්. ඉෂුව එක බලන්නේ So we can start, I think, continuation with the holding period return. So you realize what is holding period return and annualized rate of return. So we should know one more thing. Uh, Arithmetic average return and geometric average return. So arithmetic average return, you know that it is normal statistical property. So normally R bar for arithmetic average return you can calculate. You have past 10 years return, get the total, divide by 10. So that is the mean, right? That is normal mean. Right? So when we calculate this normal average or arithmetic average return, R bar, each observation are equally weighted. Right? And also, if you have taken past 10 years return data to calculate this R bar, each yearly return are independent. They are not influenced into, say, suppose 2005 yearly return is not impacting or influencing to the 2006. So they are independent as well as are equally weighted when we calculate the arithmetic mean or the arithmetic average return for alpha. So you can see this formula. This is statistical mean. When we calculate the standard deviation variance, we use this alpha. So this is we calculate using this formula. Simply total of the observation divided by number of observation. If you look at the geometric mean, second formula, so you can see here 1 plus R1 into 1 plus R2, 1 plus R3, so likewise 1 plus Rn, square root of n minus 1. So when we calculate the geometric mean, you can see each year return are affecting or impacting to the next period or the next year return. So there is a multiplication here. R1 into R2. 1 plus R1 is the one is our investment into return plus 1 plus R2 into the next year return. So you can see there is a compounding impact. Right? In theoretically in finance management, you know that very important assumption in the investment is the reinvestment. Reinvestment. So what is the reinvestment? Whatever the return you are receiving say today, if your holding period is 3 years, during these 3 years you are reinvesting. This return you are reinvesting throughout this holding period. But when you calculate this arithmetic mean, each year return or the observation are independent. So that reinvestment assumption is not implied with this arithmetic mean. But in the geometric average return, you can see that a multiplication impact is there. 1 plus return year 1 into 1 plus year 2 return into, so likewise 1 plus Rn, square root of n minus 1. 1 is our initial investment, so you can withdraw. So then you will get the geometric mean. So while I explain these two statistical properties, so the tools here, normally geometric mean means the return for the holding period. If you need to calculate holding period return, as we discussed earlier, holding period return you can calculate using that holding period return formula, as well as if it is in a long period, so then you can apply the statistical tool geometric mean to calculate the holding period return, not the arithmetic or the normal R1. Because when we calculate the geometric mean, better reflects the growth rate over multiple periods. So it's implied, reinvestment assumption is implied, as well as this geometric mean better reflect the growth of the investment. Compounding impact is there. In financial management, as an investor, the compounding value or the reinvestment assumption is very important. So with the example, you will realize this too. This is for your knowledge. If you are calculating the geometric mean, so geometric mean is suitable to calculate the holding period return. Not for calculate the holding period return. If you go with the arithmetic mean, it's not correct. Might overestimation or sometimes underestimation. But if you take the geometric mean for the holding period return, it is the correct one. So let's look at this example. You will realize this with the example. Now see here. There is a 3 years price informations are given for 2017, 18 and 19. 3 years holding period. Only price informations are given, no any dividends. During this period, just forget about the dividends, no any dividends. So only the price differences, price changes you can consider here when you are calculating the return. Now if I ask you to calculate, suppose this is a 3-year holding period return. 3 years holding period return. So using this price information, if I ask to calculate holding period return, what is the answer? Using our formula previously we discussed, you can estimate the holding period return. In 2017, you invest at 100 rupees of this company shares. 2019, suppose this is holding period of 3 years, we will end up with the investment again the 100 rupees. So if I ask to calculate holding period return, what is the holding period? What is the holding period return? No dividends, right? No any dividends income, dividends yield. Only its price changes you can consider. Holding period return, consider it is 3 years as a holding period. It is? Yes, it is. Isn't it? You may correct. What is the answer? What is the holding period return? Zero. Yes, it is zero. Correct. It is zero. Holding period return for this holding period. Holding period return. No any dividends. So then that is P1 minus P0 divided by P0. You can apply only this part of the formula. Then holding period return. So your holding period P1 is 100, P0 also 100. So that is equal to 0. That is correct. Right? Now, if I ask you to calculate arithmetic average return as well as geometric mean, so you can see the point I highlighted earlier. Now, using this information, calculate the return. These are price information, right? Company stock prices are given. 2017 it is 100, 18 is 200, 100. So now calculate the annual return here. Return. So here you can calculate what is the formula for calculating return. Return is equal P1 minus P0 divided by P0 into 100. No dividends, no. So therefore you can use only the price appreciation part. So if you calculate the return for 2017, no any information for the P0. For the 2017, if you are calculating annual return, in the question, no any information for the P0, previous year price. So therefore, you cannot calculate return for the 2017 because P0, previous year return is not, price is not there. So therefore, you cannot identify this P0 here. So here for the 2017, no way to calculate. You cannot. 2018 annual return is equal 200 minus 100 divide by 100 into 100. So how much the annual return for 2018? P1 minus P0 divided by P0. So this is the P1 when you calculating for the 2018. This is P1, this is P0. So then annual return for the 2018 is 20. How much the annual return for 2018? 100%. Yes, that is 100%. Correct. It is 100%. For 2019, it is equal 100 minus 200 divided by 200 into 100. P1 is the 100, P0 is the 200. So then annual return for 2019 is minus 25. Isn't it? Minus 50, yes. That is minus 50, correct. These are the annual returns. So you will get the answers like this. These are the returns. 100 is the 2080 and minus 50%. Return can be minus even, right? Return can be minus. It is minus 50%. Now calculate the arithmetic average return and geometric mean. So you have given annual return. So now you compute R bar and geometric mean. Arithmetic average return and geometric average return. Any question? Do you have any question? Huh? Right. So R bar is equal, arithmetic average return or the R bar is equal 100 plus minus 50 divided by 2. Even though 3 price informations are there, you could calculate it only the return for the 2 years. So therefore observations is 2. 100 plus minus 50 divided by, now number of observation is 2. So then arithmetic average return or the normal R bar is equal 25. It is 25%. This is the R bar. Then geometric mean RE. I am using RE as stated in the formula. Geometric mean is equal 1 plus R1 into 1 plus R2 square root of n minus 1. That is the formula. We have only 2 annual returns. So then geometric mean is equal 1 plus R1. So 1 plus 100. So that is 1 plus 1. 1 plus R1. 1 plus 1 into 1 plus R2. So that is 1 plus minus 50. So minus 0.5 square root of 2 minus 1. 1 plus 100, 1 plus minus 50. Number of observation is 2. This is normal square root because we have only 2 observations. But anyway, if there is a 10 observation, so that is square root of 10. Not the normal square root, right? Square root of the 10. And whenever observations are square root of 10 or whatever observation. From that answer, you have to deduct the 1. Geometric mean is how much? Geometric mean is 0. But your arithmetic average return or the R bar was 25%. Really, if you look at your holding period, you are starting with 100, you end up with 100, your holding period return really 0. But R bar, you have calculated, it was 25%, it is overestimation. It is overestimation. Really, during this 2 years period, you are not getting 25% compounded return. Because when you calculate with the average return, each observation, you consider independently and they are equally weighted. So therefore, you are getting a value like 25%. It is an overestimation. So what I should explain here, what is the conclusion? So therefore, this is the arithmetic average return. This is the holding period return. So your holding period return really 0. When you calculate the R bar, it was 25%. But when you calculate geometric mean, it was also 0. So what is the conclusion? Therefore, it is not simple average. But geometric mean is the return for holding period. If you want to calculate holding period return, so during this holding period, 3 years holding period, really your rate of return is 0. But this 25% is an overestimation. If you take decision based on the 25%, you will wrong because it's an overestimation. What is the reason? In the geometric mean, we consider growth rate we consider the impact of the growth rate during the holding period. But here when we calculate in the arithmetic mean, we didn't consider that part. Each observation we consider as an independent observation and are equally weighted. So no impact of this 10%, 100% into the next year return. So likewise they are considered as independent values. So therefore you are getting an overestimation like this. Geometric mean better reflects the growth rate over multiple periods, not the simple average. Geometric mean reflects the growth rate during a holding period. So then conclusion is, if you want to calculate holding period, the statistical tool that you should use is geometric mean, not the arithmetic or the simple average. Did you realize that? So, in order to show that, you can see the price differences in the holding period for 2017 and 2019. Prices are same. Prices are same. So, there is no growth. There is no appreciation during that period. So, really, your growth in the investment is 0. So, that is really correctly reflected with geometric mean, right? So the conclusion is, if you want to calculate the holding period return, you may go with statistical tool geometric mean, not the normal simple average. Right. So that is about the return. So next point is risk. Right. So this is about the return. So return you can calculate as a holding period return, annualized rate of return. Holding period return really reflected with the geometric mean in the statistical manner. So let's go to the risk. Before going to this one, let's look at this example. Do you have any question? In the calculator? Why? What is the problem? Look at your calculator. Coming 0. 0 in that? Another 0? 0 in all. Right. So let me see your way of calculating. 1 plus minus 0.5 into that plus limit. 1 plus R1 into 1 plus R2 plus limit. You look at the formula. Whether when you calculate the geometric field, 1 plus R1 into 1 plus R2 plus limit. Multiply 1 plus 1 they write. 2 into, not the plus, 2 into 0.5. Either 2 into 0.5 can 1. Not the way, 2 plus 0.5. Look at the formula. Into multiplication. So, when they are 2 into 0.5, again again. So, एक बार तो बोले एक formula का गाढ़ा कितनी ज़्यादा होती है? You have to look at the equation. Yeah. Your holding period in this example 3 years. you start with the 100, that is the P1, sorry, P0. You end up with again 2019 and the 100. You consider this 3 years as a holding period. The holding period is the 0. I start with the 100. Statistical formula, not the simple average. Right. For the exam, you may use the correct formula, right? In the different way, you have insert the numbers, so that is the reason for getting the different answer. So you have to apply the correct formula when you apply the formula in the calculator. If it is a problem, separately do the separately. Calculate first multiplication, then take the square root of that. From the answer, you deduct the 1. Right? So let's look at this example quickly. Nalin got 500 common shares of Lanka PLC for 75.50 rupees each. 5 months ago, current price of the share is 8.25 rupees. He received a dividend of 250 rupees per share for this investment today. How much is the annualized rate of return? How much the annualized rate of return of this investment? During the period is 500 common shares. 3 months ago, current price is 80.25. Nalin receiving dividend today 250. What is the annualized rate of return? So annualized rate of return is equal dividend income or dividend yield plus capital gain yield. This is the holding period return. Holding period return divided by holding days. 3 months ago, so you can take 30 days per month. 3 months means 30 days per month. So then 90 days, 14 days into 365. So then you can multiply it by 100. Today, Nalin receiving dividend, so that is included for your holding period. So then dividend yield is equal to 50 divided by initial or the investment, initial cost of the investment or the P0 is 75.50. 75.50 plus capital gain is there because now current price of the share is 80.25. So capital gain is there. 80 minus 25. P0 75.50 divided by P0. The answer you have to divide. This is the holding period return. 5 months. 5 months. Yes. This is 5 months. 5 means 19 to 5. Then 450 days. 450 days. Yes. Not the 3 months. Anu වැඩි කිරි පහරසේ බලන්නේ. ඒක 30 into 5. 150. So annualized rate of return. First calculate the holding period return. So then you annualize it. Holding period return divided by holding days multiply by 365. So then you will get the annualized rate of return. What is the holding period return? What is the annualized rate of return? Holding period return is how much? Huh? Bode pen. I forget to write in this screen. Holding period return is how much? Huh? 15 23.36. That is holding period or annualized. Final answer. No, holding period return. Holding period return 23 point. Final answer. Holding period return. By solving this part, holding period return 0.096. So you have to divide this by 150. 0.096. We have to divide this by 150 and multiply by 365. It is not 23%. This is a calculation, right? So holding period return is 9.6%. As a percentage, it is 9.6%. So this 0.096, we have to divide by holding days. We take approximately 150 days. Multiply by 365. So you will get the annualized rate of return 23%, 23.36%. Your annualized rate of return is 23.36%. Right. So this is about the return. Now we got the discussion on risk. So what is the risk? What is the risk? Risk. So now we should be able to calculate the risk. So this is way of calculating return. In order to go to portfolio, individual asset, now we should know how to calculate the risk. What is the risk? Risk is the variability of returns from those that are expected. Uncertainty about the return, even though you expect dividend 5 rupees, ending price like this, but anyway, these expected values, expected returns can vary. So that is the risk. Variability of returns. So now how to calculate returns? You can calculate return considering the dividend and the price changes. So what is the risk? Variability of returns from the expected or from the annualized. Even with the past data, you can calculate average return. With the forecasted data, you can calculate expected return. So simply, what is the risk? Uncertainty or the variability or the dispersion of the expected return. Now, if you look at these two bullets, if you buy 1 year treasury bill, you know what is treasury bill? Government issues the treasury bills. So if you buy 1 year treasury bill with a yield of 22%, if you hold it for full year, you will realize government guarantee 22% return. You will get the 22% return at the end of 1 year. So that is why we call it as risk-free rate of return. Because this 22% for sure you'll get. No more, no less. So that is why we call theoretically risk-free investment. No variability. Theoretically, no variability. You will not default, so you will get 22% at the end of the 1 year. If you buy common shares or the equity ordinary shares of a company and you hold it for 1 year, the cash dividend that you expected, that you forecasted when you are doing investment today, you are forecasting your expected dividend by looking at the past historical dividend payments, company profiles, company performance. You are forecasting your expected dividend because you are investing for a certain period. So during this period, you expect dividends like this. So dividends that you expected receiving may or may not materialize as you expected. It can vary. You will get more or you will get less or no dividend. The yearly price of the stock might be much lower than expected. Even though you forecasted to selling the shares at the end of the investment period, it can be vary. It can be less or it can be go up. Maybe even less than you started with. So that is the risk. That is the risk. So if you invested in the stock market, you will expose to this risk. If you invested in the treasury bills, you will get that return as it is guaranteed by the government. But anyway, if you are going to the other investment, even in the stock market, or if you go to the bonds investment even, so you are having certain level of risk. Your expected return can go up and down. So that is the variability. So how to measure that? Your actual return on this investment may differ substantially from the expected. So that you have to able to calculate. Quantitatively, you should be able to calculate this variability. So that is what we are going to do now. That is risk. So this is simply what is the risk, is the variability of the expected return. So now if you look at, this is all share price index behavior during 2018 to 2020. So you can see the variability going up and down like this. So if you calculate the standard deviation for this period, you can on average, you can have a pattern or the risk variability. Like stock returns, if you draw the similar diagram for the, say for a company, you can see stock return is going up and down. It is happening. Right? So this is for the market return. All share price index means market return. In the future, when we apply the cap wave, you have to take this. This is our market portfolio. Colombo Stock Exchange is our market portfolio. How many stocks are listed in our market portfolio? Approximately 298 around. So this is our market portfolio. 20 sectors are there. This is our economy. If you go to the US like country, there is 3 stock exchanges. So they have 3 market portfolios. India 2. So likewise in the Europe countries, more than 1 stock markets are there. But in Sri Lanka, in our context, we have only 1 market portfolio. So this is the behavior of market return based on the all share price index. Right. So then, right now you can see a distribution of 2 stocks return. Green color is the stock A, say company A. Red one is the company B. Expected return or the average return. Expected one or the average one for these 2 companies, both 15%. This is the expected. So based on our holding period return formula, you can calculate this mean or the average So that is 15% for both. Now you can see here distribution of this average for these two companies. Now by looking at this picture or this distribution, you can have some sense about the risk of these two companies' return. Now if you look at this green one, you can see its distribution is more white. But if you take the red one or the company B, it's go up. It is very narrow. It is going in peak. So now this average, okay, say expected one, there is a possibility to distribute for the company B from here. This is the variability for the company A, for the distribution of this expected return. This is the distribution for the company B, red one. Now, by simply, we didn't calculate standard deviation, coefficient of variation, variance, nothing is there. By simply looking at this distribution of this return, which company is this? A or B? Company A or B is risky. This is our expected one based on our past data, probabilities, economic situation. Say we have identified, we have calculated expected return 50%. This expected return for the company A can deviate, can go up to this, can decrease here up to this. It can increase or decrease. In the reality, it can go, can increase or it can decrease. So that is the distribution, variability. For the company A, this is the positive side or the increasing of the return, expected one. This is the negative, increasing. Simply may just forget about the statistical design. This is a normal distribution. So by simply looking at this two diagram, which is risky? Okay, the distribution is ready. Which one has the highest variability? A or B? Company A. Company A. Expected return එක variable වෙන්න වෙනස් වෙන්න තියෙන පරාසය වැඩි. The distribution is the possibility of decreasing or increasing this expected return for the company A is greater than the company B. So that is risky. That is risky. So this is by looking at the distribution. Now, quantitatively, we are going to calculate this variability using standard deviation, using variance, using coefficient of variation. Also, in the portfolio, you can use covariance. So this is what we are going to do. In the statistics, you know how to calculate standard deviation. I think in your previous courses you have did statistics, no? I believe you know how to calculate standard deviation, variance, coefficient of variation. So we are applying these things to identify risky stocks. Am I correct? On that assumption, I am not just fully. I am not going to explain this formula. I just apply the standard deviation formula and calculate the risk of this particular company. All of them are statistics. Actually, when we explain we take the statistical tool to identify the risk of the stock. So that is what we are going to do here. Right. So simply, the risk of historical return. If you have calculated average return based on the past 10 years, 15 years, 20 years, so risk of historical return, you can calculate risk or the volatility, variability of the return from the average. You can calculate using variance, standard deviation, coefficient of variation. So these formulas are not new for you. So if you look at the first one, it is variance. Once you get the square root of the variance, it is we call standard deviation. We apply this, we take this formula to identify the risk level of a particular stock. So once you get the square root of the variance, that is we call standard deviation. With the standard deviation, comparison of the two stocks is not possible when the average return is different. So therefore, in order to identify the risk, we calculate coefficient of variation. Right. Anyway, we'll do. Now, if you look at this sum, here this is alpha, average return. So deviation of the each observation from the average, scrap the deviation. So get the total divide by n minus 1. We take here n minus 1 in order to minimize the sampling error, sample biasness, because this is based on the past data, average. Sample so therefore to minimize the sampling bias or the forecasting errors, normally we divide the square of the observation deviations, its total by n minus 1. So that is variance. So once you get the square root of the variance, it is standard deviation. Variance, standard deviation, both you can use to measure risk. Higher the variance, higher the risk. Higher the standard deviation, higher the risk. So what is the difference between the variance and standard deviation? Both we use to measure the risk. But anyway, appropriate one, because interpretation is easy, appropriate one is the standard deviation. Sammatapagama, vichalataave. One is singarvachanane vichalataave, sammatapagama saha vichalata samguna, coefficient of variation. Both you can use. The difference is here variance can be a large number. When you calculate in the variance for a question, you will get a value. Can be 63, 50, 500, so likewise it is a value. You will get a number. But once you standardize the variance using the square root of that, normally if you are taking input as a return, you will get a percentage. So therefore, interpretation of the standard deviation is easy than the variance. So variance you can standardize by using the square root of that. So therefore, we take standard deviation frequently to measure the risk. Right? So normally higher the standard deviation, higher the risk. Higher the variance, higher the risk. Lower the standard deviation, risk is low. Lower the variance, risk is low. Right. Let's go to a question example. Look at this one. This is based on the average past information. So you are given return for two companies, P and Q, for past 5 years. Right? For the past 5 years. So when you calculate this return includes two components. What are those? Now if you take the return for the company P, 2017, 12%. So this 12% included two components. What are the components? This return includes two components. So how this return is calculated? Yes? This 12% has arised from the dividend and capital gain. So considering dividend yield, capital gain yield, so return has calculated and you are given past 5 years return for these two companies like this. Then after return calculate current. So using that formula, dividend yield, capital gain yield. So return was given for the past 5 years. So calculate average return discussed. But anyway, you can calculate variance, standard deviation, and average figure. So you can see the formula. This one, not new. Apply this and calculate the figure. So do it. We'll do together. Right. So you can calculate variance. Normally, variance we indicate using the square of the sigma. We call this as a sigma. As a sigma. So square of the sigma, that is variance. Stock P. Variance stock P is equal variance P is equal. So you can apply this formula to calculate the variance. For first you have to work out the average. R bar or average stock P is equal 12 plus 14 plus 17 plus minus 6 plus 15% plus divide by 5. That is the average. So average PQ first you have to calculate. මේ ඔයාලට quiz එක මෙතන ඉඳන් attend කරන්න බැයිද? What is the difficulty of doing that? 30 minutes? Using your mobile phones, is it difficult? Huh? Other groups එහෙම කරනවා. ඔයාලා මේ available ද දන්නේ නැහැ. Do it quickly, yeah? Right. How much the average? What is the average number? පුළුවන්ද දුන්නට? Can't you manage with your mobile phones, quiz? හතර කොන්ටැක්ට් කර බයිද කරගන්න. ඔව්. අමාරුයි. shuffle කරලා දෙන්න බලන්න size එක. එතකොට හතර දෙනෙක් අතට බැරි වෙනවා. හතර ඉතිරිවම නම් මෙතන ඉස්සරහ තියෙන කම්පියුටර් ක්ලික් කරගෙන දෙකේ දෙනෙක් හතර දාගන්න. laptop right laptops මේ ඔයාලගේ laptops තියන අය ඉන්නවද කවුරුද? කී දෙනෙකුට laptops තියෙනවද? එකයි. මොකද මේ computers තුනක් අඩුයි. laptop එකට යන්න පුළුවන්. තුන් දෙනෙකුට laptops තියන අය ඉන්නවද? 1 එක්කෙනාට තියෙන්නේ? ලැබ් එකක් එහෙම තියෙනවා නම් ඒකෙනුත් පුළුවන් ෆෝන් එකෙන් ඒ කියන්නේ අපිට මේ පොඩි ප්‍රශ්නයක් තියෙනවා ලැබ් එක ඔකියුපයිඩ් 12 නෑ නෑ ඔයාලගේ ප්‍රසන්ටේෂන් උත් පෝස්ට්පෝන් මේකදී අපි කරගන්න ඕනනේ කොහොම හරි ක්විස් එක කරන්න ඕනේ ඒකයි මොකද්ද ෆෝන් එකෙන් කරන්න කැමති අය ඉන්නවද දෙන්නෙක් තුන් දෙනෙක් කරලා ඉන්නවනේ ඒකට මැනේජ් කරන්න පුළුවන් ෆෝන් එකෙන් කරගන්න පුළුවන් අය don't take much serious මේක කෝපරේට් කරන්න quiz එක මොනවාද 30 minutes ෆෝන් එක කරන්න පුළුවන් නේ right එහෙනම් අපි එහෙම කරලා ලැබ් 2 එක කරගමු right right what is the average rp මේ stock p average is 10.4 yes then average for the company q 9.4 right so calculate the variance and standard deviation because you have to define the level of risk so now if you calculate the variance for the stock p you can apply the formula variance is equal deviation of the average forecasted or the estimated return from the expected 10.5 square of the deviation plus next year 2018 14% minus 10.5 square of that plus year 3 that is 2017 estimated is 17% forecasted from the average 10.5 deviation of it's from the forecasted 10.5 is the average plus 2020 minus 6 it's deviation from the average 10.5 how about it 2021 15% its deviation from 10.5 of that so get the total so that is you have to divide by n minus 1 so the years is 5 observation is 5 years so n minus 1 means 4 so that is the variance stock p variance stock p So variance stock fee is how much? $87.3. 87.3. 87.3. This is the variance stock fee. 87.3. So then you can calculate standard deviation of the stock fee. This is the variance. Sigma p is the standard deviation. Standard deviation stock fee simply square root of variance. Square root of variance. So you will get standard deviation square root of the 87.3, 9.34, 9.34. Right? So these are the variance and standard deviation for company P. Right. So due to the time total, so I am going to the coefficient of variation also. So if you look at this coefficient of variation, you can see coefficient of variation, you can calculate standard deviation divided by R bar. Standard deviation divided by R bar or the average return. So what is the meaning of this coefficient of variation? This is risk per unit of return. Risk per unit of return. So this is standard deviation. This is R bar. Standard deviation divided by average return. So it gives you risk per unit of return. Now in the company P, for the company P, if you calculate coefficient of variation, so our standard deviation was company P, standard deviation આપણે calculate करो standard deviation is standard deviation किए 9.34. So then coefficient of variation also you can calculate. Coefficient of variation for the company P is equal. Coefficient of variation for the company P is equal. Our average return is 10.5. That is average 10.5 divided by standard deviation. That is 9.4. I will go to the answers. So then, because I want to brush up, because 12 o'clock we have to start that now. Right. So, doing the calculations and applying the formula is up to you, because this is not the statistic, this is finance. So you will get the answers like this for these two companies. Company P, as we calculated, average is 10.4. Here, 10.4. For the company Q, R bar is 9.4. This is the variance, company P, standard deviation, company P. Similarly, you can calculate for the company Q also. You will get R bar 9.4. Then variance 125 for the company Q and standard deviation 11.2. So once you calculate the coefficient of variation for the company P, company Q, these are the answers. Now tell me which company is risky. Which is risky? Average return 10.4% company P. Standard deviation and also if you look at the variance is larger for company. Now look at the answer, right? Just calculate this thing at home. And you will get the answers. If you look at the variance for the two companies P and Q, variance is high for company Q. And if you compare the standard deviation, variance for standard deviation we are using to measure the risk. Standard deviation also larger for the company Q. So by comparing the standard deviation of the company P and Q, which is risky? Company Q. But anyway, for the exam, if I ask a question, what is the risky company? By comparing standard deviation, you cannot give the answer. Why? Here, R1 is different. Average return is different. Average return for company P is 10.4. For the 10.4% average, the risk is 9.3. For the 9.4% average return, risk is 11.2. So therefore, when the average return, if it is different, if it is a different number, simply by looking at the standard deviation, you cannot say which company is risky. Comparison is not possible. So therefore, in order to compare, to identify risky one, you have to calculate next coefficient of variation. Coefficient of variation. So what is the coefficient of variation? It gives you risk per unit of return. Risk per unit of expected or average return. Now if you calculate coefficient of variation, what has happened? Risk per unit of return company P 0.89. Risk per unit of return for the company Q 1.19. So there is no such condition with the standard deviation, and also with the coefficient of variation, you will suggest the same marks. No worries. But anyway, sometimes you will have a different choice when you go with the standard deviation and coefficient of variation. But fortunately, in this example, according to the coefficient of variation, this is risk. Risk per unit of return is 1.19. एक प्रतिलाभ एककेකට deviation එක risk එක 1.19. Both standard deviation, coefficient of variation high, larger for the company Q. So therefore, your answer is okay. With the standard deviation, also the risky one is company Q. With the coefficient of variation, also the risky one is company Q. Right? So likewise, by using this, further we have to define the standard deviation with the normal distribution and the set value. But anyway, time is not permitting me to continue this part. But at least you learn how to calculate standard deviation and coefficient of variation for average return. We have a lot of things to discuss, and also this is not conclusion. Based on that, you have to calculate the set value. Based on the set value, you can interpret the risk. We discuss that part. I think now it is clear now. 10 minutes. You have to shift now. So do this calculation at home. Come up with the proper reading of the reading material. I have uploaded reading material on the risk and return. You should read it. So we continue from this point because you have to go to quiz. Anyway, you may shift to the that number 2. Laptop scale है, laptop पे का आइए. Those who are in the online, are you joining to the quiz online?
Yes, ma'am.
Right. So you can go to your LMS and you can attempt the quiz, right? Okay. Thank you.